Hello guys, this is Dave Santarelli from BreakingChartAlerts.com. We're going to be getting started. This is going to be another one of our classes here. And in today's class, we're going to be talking about vertical call spreads. I want to go over this because it's really important. We're going to go over, number one, why this is one of my favorite trading strategies, especially for using it as paycheck trades. They have defined risk and defined max profits. When used with our trade plan, this is going to be a powerful trading strategy for you guys to use to capture quick returns. It's going to also help you reduce the cost of a trade and reduce your exposure in the market or in that trade. I'm going to go over why a call spread versus a call, when it's right to go with a call spread, when it's right to go with a regular call. I'm going to show you how to find your max gain. I'm going to show you how to find your max loss and when to close out of a call spread. I'm also going to show you how to pick the strikes and expiration dates properly when looking for a vertical call spread. We're going to go over how you can profit with a vertical call spread in any type of market, because it's really important to show you how to properly utilize the strikes and the legs that you have here in this vertical call spread. Alrighty guys, so let's get started here. So I brought up McDonald's, as you guys could see here. We have MCD, McDonald's. You guys could see the chart here. With our trade plan, it's been holding that 20-day simple moving average the entire breakout here, going all the way back to July. So July, August, September, for 3 months, it's been climbing. It's retracing down to that blue 20 SMA. It's having a nice breakout, climbing, retracing back to support at 20, climbing, retracing to support at the 20, and now we're getting our first climb again off that 20 SMA. So I want to go over now an example of why I love this type of strategy here. So now let's bring up the option chain here. Okay, so right here you could see we have the McDonald's option chain here. I'm looking at the October 16th, 2020 expiration. Okay, now I want to show you guys how this type of setup is going to give you defined risk and defined profits here. Okay, so first off, let me bring up my annotation software here. So you could see right here at the strikes, I have the 212.50 and the 215. The expiration date I have set here for October 16th. And obviously the type here, you can see this is a call spread. Both legs are calls. So we're buying to open the 212.50. Okay, so you could see. Now simply all this means is we're saying, okay, we're not obligated to buy it. We have the right but not the obligation to buy the 212.50 strike for the October 16th expo. Now what we're doing here, if this was a regular call, that would be the only leg. We'd be buying to open the October 16th 212.50 strike call. And then obviously here you see it's going for $7.26 was the last price, but the bid is $8.95 by $9.15. So this is going to cost you about $9 now. So your break even if you just got the call would be that 9 plus your strike. So that's over $220 just to break even. $222 just to break even. So this spread here I'm going to show you is going to reduce that risk, reduce the cost of that trade, because you're not going to pay $900 for that call. With this spread, it's going to be much less. And watch the type of profits that we're going to have here. So now, going back to this again, we're buying to open the 212.50. And again, all we're saying is we have the right but not the obligation to buy the McDonald's October 16th 212.50 strike call. Okay? Now what we're doing here, the whole point of a vertical spread is to reduce the cost of this trade and maximize profits here. Okay? So now what we're going to do is we're going to sell to open the same type of trade, a call for the same expo, but now we're selling someone the right to buy it off of us for $215 a contract. So basically, All we're doing is saying, hey, we'll buy McDonald's for $212.50, and we're selling someone the right to those shares at $215. Okay? So when we sell to open, someone's paying us a premium to buy these shares off of us for $215 if they'd like. Okay? So that's going to reduce the cost. You can see the midpoint down here right now is at about $1.70. Okay, so our max gain on this trade is going to be the difference between these two strikes. First off, a vertical call spread is always a bullish trade. Okay, you're wanting that stock to go higher. Your max gains are going to be as long as the stock's above both of these strikes. So if McDonald's is trading above $215 a share on your expiration date, this is going to give you max value on this vertical call spread. Okay, so let's say now we just had a regular call and we picked up 10 contracts. And let's just say it's going for $9. 10 contracts, multiply that by $9. Remember, there's 100 shares in a contract here. So $9, multiply that by 100. If you're picking up 10 contracts, that's going to be a $9,000 trade. Okay? So now what we're doing here by creating this vertical spread is we're reducing our cost. So we would put in a net debit limit order here. Let me change this here. So it would be a net debit limit order. It's going for $1.65 now. So let's put in that, $1.65. So now going back up, let me bring up the annotation again. The max this spread could be worth is the difference between these two strikes. So between $212.50 and $215, that's $2.50. Okay, so now if we're paying $1.65 for it, and it could be worth $2.50, that's a max net gain of 2.5. Divide that by 1.65. That's a max gain of 51.52%. Okay, so simply what this means is as long as McDonald's is above $215 a share on October 16th, this trade is going to make you a 51% return, almost 52%. Now, how much does this trade cost? So the midpoint, like we said, was $1.65. It's fluctuating between $1.65 and $1.67.5. So we put in a limit price order, meaning it's only going to fill this trade if we placed it and submitted that here. If we submit that order, it's going to cost us $1.65 per contract. But since there's 100 shares per contract, that's going to cost $165. So for one contract, it's going to cost $165. Now you see over here on contracts, I have 10. I usually do in lots of 10, 20, or 50. So 10 contracts, multiply that by 165. These 10 contracts will cost $1,650. Now, you don't have to do 10 contracts. You could do one contract if you want. The max this could be worth is the difference between the two strikes. So if you paid $165, the max it could be worth is $250. Okay, and remember, $250, multiply that by 100 since there's 100 shares per contract. So this is the nice thing about a spread, because take a look here at McDonald's right now. McDonald's right now is trading at $218.42 a share. That means that with this vertical call spread right here, it's already at max gains. But you're not going to realize those max gains until expiration day. Now, each day this trade continues to go on and McDonald's is above that 215, data is going to be taken away and you're going to slowly see profits continue to rise on this trade as you get closer to expiration. Okay? So now, again, if we go back here, McDonald's is at $218.44. This means that McDonald's could drop down $3. If it dropped down $3, that would bring it at what? $215.44, right? So if that came down to $215.44, it's up $2.03 today. So that means this could drop by over 1% from now until expiration day, and this trade's still going to make you a 51.5% return. This is a safe trade because why? Because we could see back in the chart in the background here, it's been using that 20 SMA as support. So if we have a stop on this trade at about, let's say, 215. So that's the nice thing about trading vertical spreads. We have defined risk and defined max gain. We can't make any more than 51.52% on this trade if we're paying $1.65. That's whether it's at $215 a share at Expo, $216, $220. Even if it gets up to $500 a share, our max gain is going to be 51.52%. But that's the nice thing about it, because right now we have some resistance right up here. So if we have resistance right at around 225, 225 a share, that's our resistance. So 225 a share is our resistance. 215, that's going to be our stop on this trade. And the nice thing about this is even if it does hit our stop, this vertical spread is not going to lose much value. We might only have a 10% loss on this trade if it gets down to that 215. Okay? So if it does break below that 215, that's where we would be exiting that trade. And it's very simple because we're using our trade plan as that stop. We could see in the background here how it's been coming down to that 20 SMA the entire time for the past 3 months, like we said. Once I clear this out, we'll look at the chart again. But I want to make sure you're looking at this and understanding why we're doing what we're doing. So we're bullish on McDonald's. We would come in and we would make this vertical call spread. Now, since it's fully in the money, that's the nice thing about going with a fully in-the-money vertical spread. It doesn't matter if the stock drops down to 215. It could drop by $3.61 right now. We would still make that 52% gain. It could stay where it's at. We would still make that 52% gain. It could climb to $500 a share. We would still make that 52% gain. Okay? Now, a lot of people ask, why would you go with a call spread versus a call? And first off, let me show you the background here one more time. As you can see, it's been coming down to that 20 SMA each time it's retracing. Each time it's retracing. Here was your buy signal. There's the SMA cluster. Here's the MACD. So you got your check mark, you got your check mark, and then your first green candle after that cross. There's your 3 checks. And you guys know with our trade plan, 3 check marks equal a confirmed entry. So now that you got your confirmed entry, like I said, when you're in the middle of a cycle like we are now with McDonald's, these are the times that I like to go with the call spreads. When we first get those initial crossovers, that's when I like to go with the regular spreads. And we could do something with a 30, 60, 90 day out expo and let it continue to do its climb. So when we get that first crossover with our 3 check marks for a confirmed entry, that's when I'd go with a regular call. Now, if we're coming down to support at that 20-day, that blue line here is our 20-day simple moving average. And as you can see, we're using a 3-month daily chart here. Okay? So now, there's the difference between when we're going to be using calls and when we're going to be using spreads. We're going to be trading calls when we get that first initial crossover with our 3 checks as a confirmation. Now, throughout this cycle, this is the breakout momentum cycle here. This whole green, let me bring this up here. So since that crossover here, this whole green area here, this is that breakout momentum cycle. This is our bomb cycle. And this is on a daily chart. So now that we have the bomb cycle forming here, our first time we're going to be buying calls is when we have that crossover. When we're retracing back down to support and getting that first green candle bounce off of support, that's when we could make that call spread there and we could reduce our risk. We have a tight stop because we're going to be using that blue line, that 20 SMA as our stop. So we could see right here, here's a perfect stop area on McDonald's. I'm not great at drawing, but that green line there, that's going to be our stop area on this vertical spread. Now, yes, you could pick up a call and trade it up to that resistance right here of 225, but I'm going to show you why it's better to do it like this. Now watch this. Why is it better to go with that call spread versus a spread? Or why is it better to go with that call spread versus a call? Because now let's take a look and say, okay, what's the difference between going with that call versus the call spread? Well, right now, if you pick up that October, watch this. If you pick up this October 220 strike call, all right, I'm circling it here for you. These are the calls, and here's the puts. We're going to be doing puts in another video here. But right now, your break even, we'll initiate that as BE. Break even is your strike price. Yeah, you see up here. So break even equals strike price plus premium paid for a regular call. So if you pick up that 220 strike, 220 plus, what's it going for? Theoretically, right now, it's going for $4.58 right here. So 220 plus 4.58, that means your break even is 224.58. So that's the thing. So to make 100% return, you need to add another 458. So 224 plus 224.58 plus 4.58. You have a 100% return on the regular call if the stock gets to 229.16 on your expiration date, October 16th. So here's the thing. We just went over that 215 or 212.50, 215 vertical call spread before, right? And all we needed was a stock above 215 to make that 52% return, basically. So with that call spread, the stock could drop $3, stay where it's at, or climb, and we're still making that 52% return. And the beautiful thing about that, we only need the stock above $215. And guess what? It's already above that. If we pick up a call here, just to break even on the trade, we would need it at our strike price, which is $220, plus the premium paid, $458. So our break even is going to be $224.58. And guess what? If we have resistance right here at 225, we still didn't even get to that 225. So this at Expo, if it fails to break above that, is going to be a losing trade. And you have to understand that there's different strategies to utilize during our trade cycles and our trade plan. So when we're coming off support here, it's really nice to utilize this strategy, the vertical call spread, as a paycheck trade, because we could even do a short-term trade like picking up the September 25th or the October 2nd expiration, and we could easily trade that, and obviously the stock could drop. It could stay where it's at, it could climb, and we're still going to make a decent return. I mean, think about it. A 52% return in a week or two or even a month until October 16th, that's a heck of a trade. That's a really good return. And especially now knowing that your stop is so tight here. 215 is going to be your stop. Now, if you have the regular call and it drops down 215, you could look at your delta and see what it's going to lose. So if it drops by $3.50, 3.5, multiply that by your delta of 0.46, that's going to lose about $3 in value. So it's really important to understand that you're reducing your risk, you're reducing your exposure, and it's also bringing the price point down. Because like I said, on this vertical spread down here, the max it could be worth is $2.50. Okay? If we're only paying $1.70, McDonald's is going higher now. So you see, if you got it for $1.65, you already made $5 a contract. If you have 10 contracts, you just made $50 while we're going through this video here. So now again, the nice thing about that, the vertical spread here, you're making max gains with McDonald's above $2.15. Going with the calls here, you need it at your strike price plus premium paid just to break even. And then obviously to make a 100% return, add another premium, and that's where your double is. So at $229.16 a share, you make a 100% return if you just picked up that 220 strike call for that price we were talking about, $4.58. So that's the nice thing about the calls versus the call spread. Okay? Now I want to talk about a little bit more here. When are we going to close out the spread? So if you look here, like I've been talking about, that spread, you want to make sure, especially when we're trading a paycheck trade, you want to make sure you're following those stops. And it's really important, first off, that you're looking for good trade setups. You guys know the market's been pretty volatile lately. It's been pretty crazy. So what's really important here is following your stops and following your targets. Because as you can see here, we've been using that 20 SMA the entire time here. And then we're breaking higher. Coming down to support at that 20 and breaking higher. And now I'm expecting that same thing. So now we're going to have resistance right at around 225. So if she climbs up to 225, great. Our vertical spread made money. And it made a 52% return. If we bought that 220 strike call and it just gets up to 225 and it fails to break above it with that call is going to lose money. That call is going to lose money. Whereas the vertical spread just made you a 52% return. So it's really important to understand the different strategies we're utilizing here throughout the trade plan. Okay, and also what I wanted to talk to you guys about here is look at how beautifully McDonald's has been following our trade plan. It's got nice breakout momentum. It retraces back down to that 20 SMA, which is acting as our support. Another big breakout. It retraces back down to support at that 20 SMA. It climbs again, has a big climb, and then that first candle below the previous candle body is showing you signs of retracement back down to support. So it came back down to support now, and now she's starting to climb again. Now, if you're looking to add to the trade, we could go into this later, but something you could do with your vertical spread then is if this continues to climb, you could do a couple of things. Either you could buy back that short leg to uncap your gains, or B, you could add to the call side. So if we take a look at this again, and let's say it breaks above that 220 area, and you have this 212.50, 215 vertical spread, right? So if she breaks above that 220, and it looks like it's going to that 225 second resistance area, all you're doing then is, you got 10 contracts of each here. You're long 10 contracts of the 212.50, you're short 10 contracts of the 215. So if you want to turn this into a ratio spread after it breaks above that first resistance, what you could do here is maybe add another 5 or 10 contracts to the call side. Leave the short side alone, but add to the call side here, and that's going to turn it into a ratio spread. So that's a great idea. That's a little bit more advanced, and we could go over the techniques and everything in the next class or another class about how to turn spreads into ratio spreads and whatnot. But right now, the really important thing is understanding when to go with that call versus that call spread. And like I said, you have to do your math. So if you're looking here and you're saying, okay, let's go to basics here. If you're picking up that call and you're picking up that October 16th expo, that 220 strike, you're seeing, let's just say right now, last price is $465. So last price on this is $465. And if you pick up that strike price of 220 for that October 16th expo, your break even is your strike price plus premium paid, which equals 224.65. So that's just where you need the stock to go to break even. Okay? Now to make a 100% return, all you're doing is adding another $4.65 to this. So $4.65 added to the break even, and 224.65 plus 4.65. So at 229.30 equals a 100% return. So you have to ask yourself, is that resistance level we were just talking about, is it higher than 229.30? And if you're looking at this chart here, we have resistance at 225. So that's telling us no, resistance is not higher than that area. So that tells me I'd rather go with that vertical spread we were talking about compared to the call. Because if we fail to break up to, our break even at least of 224.65, that's going to be a losing trade. Whereas that other trade we were talking about, that spread, which if we go back here to, that spread right here, as long as it's above that 215, it's going to make us that max gain. And the max gain is the difference between the strikes. So the difference between 212.50 and 215 is $2.50. Divide that by what you pay. So if you have a net debit order in for 65 cents, 2.5, divide that by 1.65, that's a max net gain of 51.5%. We'll round it up to 52%. So your max gain on that spread is 52%, and the stock could drop by $3, stay where it's at, or climb. Whereas this call here that we just went over, you need it at 224.65 just to break even. You're already down on the trade as soon as you make this call. Whereas that spread, hey, you're at max gains already. But you're not going to realize those max gains until that expiration date. Okay? So we went over how to find the cost, why it reduces the risk of a trade, how it reduces your exposure, and why we would go with a call spread versus a call. We also went over how to find your max gain. Okay? You find your max gain by the difference of the strikes. So the difference of the strikes here, 212.50 to 215, that's $2.50. Okay? So that's your max gain. If you're paying $1.65 for it, obviously your max gain is the difference between this price and that price. So if you're paying $1.65, remember 100 shares a contract, so just multiply each of these by 100. So you're paying $165 for one contract. As long as McDonald's is above 215 by October 16th, that contract, this spread, is going to be worth $250. So 250 minus 165, you just made $85 for a single contract. Now, if you have 10 contracts, 85 times 10, you just made $850. And that's why I like to call these our paycheck trades. Because when we find these good setups of a stock bouncing off the support there, we could come in and do a shorter term trade like the September 25th or the October 2nd expo, and we can make one of these as our paycheck trade. So obviously, $850 gain for 10 contracts, that's not bad. Now here's the thing. 10 contracts is going to cost you $1,650. So you're paying $1,650 for 10 contracts, and those 10 contracts could be worth a max of $2,500. You're paying $1.65 for it to be worth $2.50. So that's not bad. You're paying $165 for one contract, and that could be worth $250 as long as McDonald's is above that $215 by your expiration date. And that's the beauty of having these as our paycheck trade. Because like I said, if we're disciplined enough and you know the trade plan, that's why you see all these members taking classes, and now the classes are going to be uploaded for the elite and pro members here. You're going to be able to see, where's our stop going to be on that vertical spread? Our stop's going to be 215. 215 is going to be our stop on this trade, because if this trade breaks below that, it hasn't done that in 3 months. So if it's doing something different than it has in 3 months there, and we're seeing momentum start to shift there, then we want to get out of that trade. And we're going to minimize our loss with that vertical spread there compared to if we went with those calls. So these are a great opportunity there to find during mid setups. Now I want to just go over one more chart here with FedEx. Take a look at FedEx here. We made a trade yesterday on FedEx. And this was one of our paycheck, or not our paycheck trade, our trade challenge account trade. We made a trade on FedEx yesterday off of this bounce off the 10-day, because you could see FedEx since all the way back in, what's 6? That's June, right? June, July, August, September, for 4 months, FedEx is holding above that 10-day simple moving average and climbing. Coming down to support at that 10-day simple moving average, climbing. Holding support at that 10, climbing. Coming down to support at that 10 and climbing. So yesterday we picked up that trade on FedEx. And what did we close that out for today? We closed out those regular calls on that one climb there to resistance at 250. We closed that out for a 50% return in 1 day, less than a day. So that's an opportunity where we have strong momentum and we went with a regular call because we have a strong breakout. FedEx and UPS were just upgraded, and it's also part of a cyclical trend here. The holiday season's coming up, and usually, typically, you'll see these carriers here continue to climb throughout the holiday shopping season. And that's what we're continuing to see. Even though we had that big market pullback last week, you could see FedEx, UPS, it still held momentum and still climbed. You know, it had a little bit of a retracement for a couple of days here, but it's still holding above that 10-day simple moving average, which is a strong sign of a strong momentum and a strong breakout. So like I said, yesterday we got some regular calls on FedEx because of the momentum on FedEx, because of it being a holiday cyclical trend, and because of the upgrades. We have 3 big things going for it. So when you have something like that going for a stock, that's when you want to go with the regular calls versus a vertical call spread. So I really hope that helps you guys understand why we're going with calls versus spreads at some time. Like I said, McDonald's here is a great opportunity. If I go down the list here, I'm sure I could find a few more. I have this linked to my watch list. Here's another one that came down. This is Merck. It came down to that 50 SMA. You know, but it's not much going on. It's been trading sideways, so I wouldn't be looking at that. Microsoft's not doing much. Nike had a big earnings breakout there. Here's one on Nova. You could see you got some resistance right at around $29 a share. This is something you could pick up some regular calls on and trade it up to that $29. Nvidia, not doing too much yet. Here's one here, Overstock.com. You know, see how it's been holding above that yellow 10-day simple moving average? Well, the first green candle above that blue 20 and red 50, if you got in there, let's say at $83, you know, we have our next resistance at 100. That's a 15-point gain. So that's something I would pick up some regular calls on and trade it up to that resistance area of $100. That's really important because what else you're looking at here is if you picked up that call, your stop is going to be this area consolidation. And if we draw our consolidation box here, you could see, watch this. Our consolidation box is right here. So if you got a red candle below this consolidation box, that candle would be your stop. So that's the beauty of trading calls versus trading spreads. You know your risk, you know your reward, and you know what strategy is best to use to maximize those potential gains. So like I said, Overstock, you're looking at that $100 to be your target if it broke above. That $100 area, that's your target area. Okay, so you get a green candle above that blue 20 and red 50. So let's say right here you get a green candle. This right here is your buy signal. So you'd have your buy signal. If it dropped below here, that's going to be your area of stop. And this would be a nice opportunity to pick up a call because obviously $80 to $100 a share, that's a pretty darn big gain there. You know, that's a 25% return in the underlying stock there. And with options, that could be a few 100% return. So there's some really good opportunities here to be able to look at and understand when you're going to be going with the call, when you're going to be going with the spread. And the main thing is, Like here's another one on Pinterest. This one's got some momentum continuing to climb. You know, this is one you'd be looking at the analyst. What are they saying? Do they have a price target of $45 a share? Do they have a price target of $50 a share? If so, you got your MACD cross, you got your 1020 cross back up here. You just broke resistance right here at $40, and now you could trade that up to where analysts are expecting Pinterest to go. The nice thing now about that is you know when to go with a call and when to go with the spread. And the main part is you have to remember you're going to be going with that call spread there when you're coming down to support. If you want a paycheck trade, like right here, you're coming down to that blue 20 SMA. So if you wanted to do something like that week's expo off of this climb here, you could get something like the September 25th expo on Snap and do an in the money vertical spread and collect that paycheck. And then if you still feel this is going higher, and you can see it's been coming down to that 20, climbing, back down to that blue 20 SMA and climbing. Now our next resistance area on Snapchat is going to be around 26.50. So if you picked up calls, you know you got about an 80-cent climb to get up to that next resistance. And that's really easy to figure out what that trade's going to do with using your Greeks, your delta here. So if you picked up the September 25th expo and you picked up the 25.50 call, you can see that's going for about 21 cents a contract. So if that got up to 26.50, or I'm sorry, the 25.50 here is going for about 61 cents a contract. So you can see 61 cents a contract for the 25.50. You have resistance here right at around 26.50. So 26.50 is going to be your target resistance. So obviously 26.50 minus 25.50, the max that could be worth is $1. If you're paying 61 cents for it to be worth $1, divide that by 0.61, that'd be a 64% return on that call if you traded that call. If you bought that call now and it got up to that target resistance of 26.50, that's a 64% return. So it's really important there to understand when to go with the calls, when to go with the spreads. Now you know when to go and how to find your target resistance areas, how to find your stops, when to go with a call, when to go with a spread. And like I said, the most important thing here is vertical call spreads. They're defined risk, they're defined max profits, and you have a lower risk of losing a lot of money on these. You know, obviously the max you could lose on a spread is what you pay. So in that example on McDonald's here where we talked about it being $1.65, that's the absolute max you could lose is that $1.65 a contract. So $165 max loss compared to if you just picked up that call that was $900, I'd rather risk that $165 than that $900. So that's really important to understand. And look at Walmart or McDonald's is still climbing since we've been going over this. And if we change this to today 1 minute, look at that breakout here. So that's a today 1 minute chart. But 3-month daily, that's what you're looking at for these swing trades. Don't worry. If you're in swing trades lasting over a week, don't worry about looking at a today 1 minute chart. You're just going to get emotional. You're going to become impatient. And it's really going to screw with your trader psychology. So all I want you to do when you're trading vertical call spreads, look at a daily chart and make sure you're watching your targets, your stops, and following that trade plan. So I really hope this video here helped you guys understand why we love trading vertical call spreads in a bullish market. The next video we could go over vertical put spreads. And obviously vertical put spreads make money as the market goes lower. So that could be one of our next classes here. But remember, the most important thing here, it's a great strategy to use to find those paycheck trades. It gives you defined risk. You know your max profits. You know when to use it with the trade plan. And this is a powerful strategy to capture those quick 50 to 100% returns in a very short period of time. It reduces the cost of the trade, like we showed you, $165 compared to $900 if you went with the call. We showed you how to find your max gain, your max loss, when to close out of the spread, you know, and obviously that's when you get the first candle with the body below support. and how to pick the strikes and expo dates. If it's a short-term trade like this that's just bouncing off support, this is something you might want to get this week or next week's expo on. You know, if you're getting the first crossover, the 1020 crossover, and it's just changing cycles, that's when you want to go with the call. Or that's when you want to go with maybe a slight out of the money vertical spread and look for that 200% max net gain on that vertical spread, maybe a month or two out. Because let's say you got the 197.50 200 vertical spread right here on this crossover when the stock's at $187 a share. Well, if it climbed 13 points there and you got that out of the money vertical spread, that's going to make you a heck of a gain. For example, if we look at this quick here and just show you an out of the money vertical spread now for the same expo, let's take a look at October 16th expo. And let's just say that we went with an out of the money vertical spread here for another, 12, 15 points higher. So let's say we went with the let's say 230, 250, 235 vertical spread. Watch this. Now take a look. So if this stock has some serious momentum, look at this. Your max net gain is the difference between the two strikes. So again, $2.50. But look at the difference. Here you're paying 32 cents. So here your net debit's going to be 0.32. So if you're paying 32 cents or $32 for it to be worth $250, that's a max net gain there of 2.5. Divide that by 0.32. That's a max net gain of 682% return. So by going with a further out of the money spread for the same expo date, now you need the stock above 235. So it's at about 220 now a share. So if it climbs 15 points from now until October 16th expo, it's at 30 cents now. So 250, divide that by 0.3, that's a 733% return. And that's the difference of going with the out of the money vertical call spread compared to an in the money. If it's in the money, the stock could drop, stay where it's at, or climb, and you're going to make that same max value. Here, you need the stock to literally climb at least $15 to make that max gain. But here's the beauty of it. It's only going to cost you $32 for one contract to be worth $250. So again, if you have 10 contracts, you're going to be paying around $320 for 10 contracts. That 10 contracts, the max gain on that is going to be $2,500. So you're taking $320 to $2,500 if McDonald's is above $2.35 a share by your expiration date. So that's the difference between going with an in the money versus an out of the money. Obviously, an out of the money vertical spread, you have a lot more risk. The stock and the trade is much cheaper. It's only 32 cents, but here's the thing. You need that stock to climb by 15 points, and then you're going to make that 733% gain on expo date as long as McDonald's is above 235. So now I'm going to open up to some questions and answers, and I'd be glad to go over any questions with you guys. And I really hope you guys enjoyed this class here, because it's really important to understand why you're picking one strategy over the other and how one strategy could benefit you much more than the other, and how to find your max risk, your loss, and your max gains. Alrighty, guys, I hope this class helped you guys, and I hope you guys have a great day and a great trading week. Take care, God bless, and have a great night. We'll do some Q&As now. Thanks, guys.
Okay, send me